pace in July, though inflation remained elevated. Here's how investors reacted on Bloomberg.
It's a positive that some of the inflationary pressures are moderating.
If it's slowing down, then it's not ripping out of control.
My biggest fear is on the labor side.
We're in the midst of an inflation heat wave here.
Inflation will ultimately prove transitory.
I don't think inflation is all transitory. I think some of this will stick around.
Pay increases are more sticky part of inflation.
Too early to be too relieved, but a good sign, no doubt.
It gives justification for the Fed to delay tapering.
What they should be doing is getting ready to raise interest rates.
About a 1 in 3 chance that they hike next year.
If these inflation numbers stay high, they'll have the flexibility to raise rates against that firm economy.
Well, joining us now is Karen Ward, JP Morgan Asset Management, EMEA Chief Market Strategist. Karen, after a pretty quiet couple of days in August, first of all, good morning. What are you expecting to kind of give direction to the markets into September?
Well, I think Jackson Hole, as you discussed this morning, is the key event. I mean, the US economy looks extremely strong to me. I'm not particularly concerned about the Delta variant derailing that story. The jobs market is what's absolutely critical, and it's red hot. We're seeing across payrolls, the JOLTS data. This is an economy that's really firing on all cylinders as we head into the back parts of the year. And so the real question is, what are the Fed going to do about that? And we're all just looking for those signs as to what their exit strategy is going to be. So I think Jackson Hole is a key potential catalyst for that. And otherwise it will just be focusing on, we will be keeping an eye, of course, on that Delta variant. But otherwise it will be, I think, all focus on the jobs markets around the world. That's really the key driver here.
Karen, when you look at some of the other driving factors, a lot of the focus, of course, is what central banks do. How much of it is already priced in?
Well, I think, when I look at longer term interest rates, I think, there is an underlying assumption that the central banks are going to be happily much too late. They're going to be delaying as much as possible the withdrawal, particularly of their balance sheet policies. And while I think that probably is, broadly speaking, the right best guess of what happens, that's where the risks are to me. I think if the central banks start to have a reassessment of those balance sheet policies, and of course we got a glimmer of that from the Bank of England earlier on this month. I thought the bank setting out its exit strategy and really re-emphasizing the role of balance sheet reduction in that was really noteworthy. And if we do start to see the other central banks around the world say, well, maybe that's where we actually want to withdraw our stimulus, less focus on the short end, more on removing that excess liquidity, then I think markets are not priced for that. So I think that's the key risk that I'm looking to as I pick through the communications that we're going to get, not only at Jackson Hole, but at their regular meetings.
So, Karen, what do you do? I mean, do you buy any VIX right now? Or is there something that actually looks pretty attractive at these kind of levels that is still underbought?
Well, I think if you believe, as I do, that the central banks, are going to indicate that they are easing their foot off the accelerator, and at the same time as they're reducing their purchases of government bonds, we're going to have new infrastructure packages, clear signs that governments aren't easing their foot off the accelerator. That points to me towards interest rates rising in the back end of the curve as we move through the course of the next 12 months. And then that really, I think, spits out a whole load of other trades. It's been very clear this year that value growth, financials versus tech, and then in turn some of the regional movements are really coming out of that trade on the 10-year. So on days when longer term rates are rising, we see that that's good for financials, less good for some of the growth, the tech areas of the market. And therefore, those are the days when places like Europe do particularly well. So I'm really looking to a continuation of that rotation as we move into the back end of the year.
So, Karen, on tech, actually, what's your take? Are you? It seems that we saw quite a big sell-off, or certainly a sell-off in the last couple of months. Does that continue, or are there pockets of growth that you see?
Well, I think that tech is a secular strong story still. I mean, I think we can't deny the fact that these companies are just kicking out fantastic earnings every quarter. This is not like the tech boom of the 2000s. This is a very strong secular earnings story that we do really believe in. So I'm not concerned in a major way about a significant tech sell-off. I think just the underlying fundamentals are too strong. But I do think that tech has been one of the key beneficiaries of ultra low interest rates. So they've benefited from strong earnings, which was boosted by the pandemic, but then they've had a super boost from those future earnings not being discounted at higher interest rates. And I think it's just that shine that could eke out of areas of the tech story. But I think, it's really about then using those broad sell-offs when perhaps that we could see when the 10-year has days where it really moves, to maybe actually move into some of those companies where you're really convinced about the secular earnings story. So I think it's about being discerning really within the tech sector, but noting that there will be days where, particularly if we have significant moves in the US 10-year, then tech would be under pressure.
Karen, thanks so much. Karen Ward, JP Morgan Asset Management EMEA Chief Market Strategist.